have two great speakers to start with this workshop. And the first one is William Reardon. And William is a trader and educator specializing within the intraday environment of modern tape reading by exploiting supply-demand imbalance using analytical techniques derived by Wyckoff. He has done a 3 series of tape reading with the Wyckoff method presented at the Wyckoff Best of Wyckoff 2021 online conference. He co-hosts the weekly tape reading lab with Rahman, and he's done an amazing amount of work, including the S&P Chronicles. And so do go find out and check out William's incredible efforts and career. And then we have, in addition to that, let's get to Rahman's page here. And so Rahman is the founder of Wyckoff Analytics. He is a trader educator specializing in the Wyckoff method of trading and investing, which he has taught for more than 15 years at Golden Gate University and at Wyckoff Analytics. He is the founder and president of Wyckoff Associates, an enterprise providing online Wyckoff method of education to traders throughout the world at wyckoffanalytics.com. And with that, I want to get out of the way, introduce these amazing people. And so I will stop my screen sharing, and thank you, William and Rahman, for getting us started and for being here.
Thank you, Bruce. And here we are.
Thank you, Bruce, and thank you, Ifta. It's a pleasure to be here.
All right, I think my screen should be on.
I see it.
I see it.
Okay, thank you, Bruce. All right, well, William, here we are. So S&P and oil, we're doing the pre-market analysis. We have about 20 minutes.
Yes.
And why don't you take it away? Because I know that you've got a very good routine under your belt for the pre-market analysis. And I will be just cutting in with some comments or maybe questions.
Yep. Okay. So the first thing I like to do coming in, obviously being an intraday trader, is the top-down approach, where we look at the daily time frame, the 60-minute time frame, and today the trigger time frame, our entry points, will be the 3-minute time frame. Now, I have to say this, bear in mind that we are trading with multiple time frames, and we'll be using 60-minute structure, with the 3-minute being the trigger. So if we trade the trigger bar near the 60-minute structure, we don't have a 3-minute trade, we have a 60-minute play on our hands. And I think it's incredibly important for our audience or the traders to understand this with clarity, because our expectations will be different. You know, how we manage the trade will be different due to the nature of the higher time frame, with the lower time being the trigger bar. So if we have a bias, Roman, within the multiple time frames, and they are in alignment, our entries, they don't really have to be particularly clean. Why? Well, because we need to be aggressive if the market is confirming our multiple time frame alignment. And being our trigger time frame, being a 3-minute, we don't want to wait for picture perfect kind of entries. We just want to jump on board the move. Otherwise, it could be too late. And I think it's important, again, that we make the distinction and understand the environment that we're in and the kind of trades that we're looking for, because this prepares our mindset going forward, again, which is incredibly important. But that being said, Roman, we are still looking to trade kind of organic 3-minute plays, and these occur on the trigger time frame, being a 3-minute time frame. But these are unforeseeable. You know, they arise organically within the trading day. So the first thing we need to do, let's look at the S&P daily time frame. And what do we see here, Roman? Can you see me drawing on the screen here?
Yes.
Yes, excellent. This, of course, is an up thrust. And where are we? In an area of supply here, in an area of supply. We draw this down here. We get a spike in volume locally here on this bar, spike in volume locally, and here on this upthrust, spike in volume locally. However, Roman, what are your thoughts on this upthrust? Because I think, as we've spoken about, it's not as clean as these kind of supply bars over here to the left, but supply still emerges in an area of supply. So what's your take on this upthrust?
Well, I was actually encouraged by the upthrust itself, and let me tell you why. Even though we're seeing all of this weakness right here, and I think it's related definitely to yesterday's Fed event, where they basically say, no. Even though the inflation is showing some kind of cracks, right? So we're seeing some kind of inflationary pressure to deflate just a little bit. We're still going to be raising. We're still going to be raising by 50 points. We're still going to be raising in February and March by 25 each time, and that is not what market wanted. So therefore, the testing yesterday was the bias to the upside. And I thought that today, if we're going to break to the downside, then that puts kind of like more pressure for us to go to the support level right here.
Yep, and that's a very important support level for this market as well.
And I would say also for me, this 1/2 of the CPI big bar is also very important. Why? Because you don't want to see any type of commitment like this to the downside, where you see the close committing below this level. This would automatically mean to me that we're probably coming back into this structure and we're retesting possibly even these lows. So we kind of at the very interesting spot right here on the daily, coming back to just like the idea of the upthrust. I like when the price not just touches the moving average or not just touches, let's say, some kind of downsloping resistance, but it actually overcomes this, because that tells us that there is strength and the buyers are able to push the price higher and trade above, let's say, 200 moving average, which is very important. Then we saw how on the upthrust itself, we have an extension even more. We're obviously extending to an extremely important resistance here, and therefore expected that supply is going to be here. Supply is going to increase. The question yesterday and today was more about, after the Fed announcement, how are we going to test? Are we going to test and, kind of like go to the upside or to the downside? So we're most definitely resolving to the downside. And that's kind of like the mental outlook that we have here. So at least for now, I would be thinking like, okay, short-term bias to the downside, very important support right here. And then let's see what happens here.
Yeah, I agree here. We're in a downtrend. And what would we expect to find in a downtrend when we're at, for example, over here, this resistance level, and we're overbought in this, we're at the supply line and we find supply, and this resistance level over here, Roman, this we spoke about this breakout bar. We can compare the analog from this breakout bar to this breakout bar. Higher volume, smaller spread, effort versus result. So there is selling in this bar. The very next bar, look at the volume, very small spread with high volume. So there's still selling in this area. And then the market is unable to break above that. So given the CPI day, we overthrow the supply line here, come back in, and then the Fed day, kind of a little bit of indecision, and now we're kind of, continuing down. So I would say that this market is actually acting as it should. Everything's respecting, the overbought condition. We're respecting resistance levels. We see selling over here. We can use the analog, and where are we? Again, we're in this area of supply. So from the macro perspective, in the immediate, I would be expecting downside continuation. So that being said, should we drill down to the 60-minute time frame, Roman? Not as clear, I don't think, the 60-minute time frame here. What are your thoughts here? I mean,